I've been investing for over 7 decades, and I can tell you right now, what I'm seeing in today's market reminds me of some of the most dangerous periods I've witnessed in my entire career. While everyone's celebrating and the financial media is cheering record highs, I've quietly repositioned over $325 billion, and what I'm about to share with you could save your portfolio from a devastating loss. Value proposition. Listen, I don't make these moves lightly. At 95 years old, I've seen every market cycle imaginable. I've watched fortunes made and fortunes lost. And I'm going to spend the next 30 minutes explaining exactly what I'm saying that Wall Street doesn't want you to know. I'm going to walk you through why I'm holding more cash than I ever have in Berkshire's history, why I've been selling stocks that I loved for decades, and the 3 investments I'm watching right now that could define your financial future in 2026. Now, before we go any further, I need to be crystal clear about something. I'm not giving you financial advice. I'm 95 years old. I've got more money than I could spend in 10 lifetimes, and my situation is completely different from yours. What I'm sharing is what I'm doing with my money and why. You take that information, you think about it carefully, and you make your own decisions. Got it? Good. Let's begin. I'm going to be honest with you about something that might surprise you. Right now, at Berkshire Hathaway, Charlie and I, well, now it's just me since Charlie passed, but we're sitting on $325.2 billion in cash and short-term treasury bills. Let me say that again. $325 billion in cash. People ask me all the time, Warren, why aren't you investing? The market's going up, you're missing out. And I'll tell you what I tell them, I'm not missing out on anything. I'm waiting. And there's a big difference between missing out and being patient. Why I keep cash. Look, I've always kept cash on hand. That's been my strategy for 70 years. You need to stay liquid so when opportunities show up, and they always show up, you can write the check immediately. No hesitation, no scrambling to sell something else at the wrong time. But this isn't just keeping some powder dry. This is the largest cash position in Berkshire's history. Not just in absolute dollars, though it's certainly that, but as a percentage of our total assets. We've been building this position for 18 months while the market keeps climbing higher. What this really means, I'll tell you exactly what it means, and I'm not going to sugarcoat it. I can't find anything worth buying at these prices. That's it. That's the whole story. When I look at the stock market today, I see prices that don't make sense given the risks. I see companies trading at valuations that assume everything is going to go perfectly for the next decade. I see speculation that reminds me of periods that ended very badly for investors. Learning from history. I've done this before. In 1999, during the dot-com bubble, everyone thought I'd lost my mind. The internet was changing everything. Amazon was going to $500. Pets.com was the future. And there I was, sitting on cash, refusing to buy these amazing companies at insane prices. People called me old-fashioned, out of touch, said I didn't understand the new economy. Then the NASDAQ dropped 78% over the next 2 years. Suddenly I didn't look so old-fashioned anymore. In 2007 and 2008, I was building cash again. Not because I knew exactly when the crash would come, nobody knows that, but because I could see the housing market was built on fantasy, banks were over-leveraged, and risk was being repriced incorrectly. When Lehman Brothers collapsed and panic hit the markets, I had $44 billion ready to deploy. I bought Goldman Sachs. I bought General Electric. I got incredible terms because I had cash when nobody else did. Those investments made Berkshire billions. The pattern you need to understand. Here's what I want you to understand. I don't try to time the market perfectly. That's a fool's game. What I do is prepare myself to act when opportunity appears. And opportunity appears when other people are forced to sell, when panic sets in, when quality businesses trade at irrational prices. Right now, I'm preparing. And I'm preparing bigger than I ever have before. The hard decisions. Now, let me tell you about what I've been selling, because understanding what I'm getting out of is just as important as understanding what I might get into. 1, Bank of America a relationship that changed. I love Bank of America. I really do. In 2011, when everyone was terrified of banks after the financial crisis, I invested $5 billion in Bank of America. It was a great investment. The company needed capital. I provided it, and we both won. But starting in July 2024, I began selling, not dumping. I never dump stocks, but systematically reducing our position week after week. We sold over $10 billion worth of shares. Why would I sell something I loved? Simple: price and risk. Bank of America stock had rallied significantly. It was trading at premiums we hadn't seen since before 2008. At the same time, I was looking at their commercial real estate exposure, and I didn't like what I saw. Office buildings are in trouble. Mall properties are struggling. And banks have a lot of money tied up in those loans. I learned a long time ago, when you've made a good profit and the risk reward gets less attractive, you take some chips off the table. It doesn't mean Bank of America is a bad company. It means at that price, with those risks, I'd rather have cash to Apple. This one hurts. This is the one everyone asks me about. Apple has been my largest holding for years. I call it the best business I've ever seen. The ecosystem, the customer loyalty, the profit margins, it's an incredible company, and I've been selling from mid-2023 through 2024. I reduced our Apple position by more than 60%. We went from owning about 905 million shares to roughly 300 million shares. That's a $90 billion reduction. Let me explain my thinking, because people have really misunderstood this. First, Apple stock has had an incredible run. When we first started buying Apple significantly back in 2016, it was trading at about 10 times earnings. Today, it's trading at over 30 times earnings. The company has grown, absolutely, but the stock price has grown even faster. Second, and this is important, the size of our position had become dangerous. Apple was representing over 50% of our entire equity portfolio. I don't care how good a company is, concentrating that much of your wealth in a single stock is imprudent. Charlie would have killed me if I let it stay that way. Third, I'm looking at tax considerations. Capital gains tax rates are at historic lows right now. If I believe, and I do, that government spending and deficits will force higher taxes eventually, then selling some Apple now at a 21% corporate tax rate is smarter than selling it later at 28% or 30%. But here's what I want to emphasize. I still own 300 million shares of Apple. It's still our largest position. I'm not abandoning Apple. I'm sizing it appropriately and taking advantage of an opportunity to realize gains at favorable tax rates. 3, other reductions. I've also been reducing positions in several other companies. Chevron sold a big chunk. Capital One significantly reduced. Paramount Global exited entirely. The common thread? These were all positions where either the price had gotten ahead of the value or the business fundamentals had changed in ways that made me less confident about the next 5 to 10 years. The honest assessment. All right, let me tell you what's really keeping me cautious. And I'm going to be more direct than I usually am in my annual letters. The valuation problem, the S&P 500 is trading at about 21 times forward earnings right now. Historically, the average is around 15 to 16 times. Now, you might say, Warren, it's only 30% above average. That's not a bubble. But here's what worries me. Those earnings estimates assume everything goes right. They assume no recession, no major disruptions, continued consumer spending, stable interest rates, and perfect execution by corporate America. I've been around too long to believe in perfect scenarios. The interest rate reality. For 15 years after the 2008 crisis, we lived in a world of essentially free money, interest rates near zero, central banks buying everything in sight. It was easy to make money, just borrow cheap and buy anything that yielded more than zero. Those days are over. The 10-year Treasury is yielding over 4%. That changes everything. When I can get 4.5% to 5% in Treasury bills with zero risk, I need stocks to offer significantly more potential return to justify the additional risk. And at current prices, many stocks don't clear that hurdle. The consumer debt situation, I'm watching consumer debt levels very carefully. Credit card debt in America is at record highs. Delinquencies are rising. Student loans are crushing young people. Auto loans are stretching longer and longer to keep monthly payments affordable. You know what that tells me? The consumer spending that's been driving economic growth is being powered by borrowing, not by real income growth. And borrowing-driven growth always ends the same way, badly. The commercial real estate time bomb, I mentioned this earlier with Bank of America, but it's worth emphasizing. Commercial real estate is in serious trouble, especially office buildings. Companies have figured out that remote work actually works. They're not renewing leases. They're downsizing office space. Meanwhile, property owners have mortgages based on rental income that's not coming in anymore. A lot of those mortgages were written at low interest rates, and they're coming due. Property owners will need to refinance at much higher rates, with lower occupancy, with falling property values. The math doesn't work. And guess who owns those mortgages? Banks, regional banks especially. This is going to cause problems. The geopolitical uncertainty, I don't usually spend much time on geopolitics. I can't predict what politicians will do, and neither can you. But I'd be negligent not to mention that the world is more unstable than it's been in decades. Trade tensions, potential conflicts, energy security issues, supply chain fragmentation, all of this creates uncertainty. And uncertainty is the enemy of valuation. My conclusion, when I add all of this up, I see an environment where the potential returns don't justify the risks. Could the market go higher from here? Absolutely. It could go 20% higher before any correction. Markets can stay irrational longer than you'd think. But I'm not in the business of hoping I can sell to someone else at a higher price. I'm in the business of buying good companies at prices where the math works in my favor. And right now, the math doesn't work. Where opportunity might appear. Now, I'm not sitting here completely inactive. There are 3 areas I'm watching very carefully where I think opportunity could develop. 1, energy infrastructure. I've always liked energy infrastructure, businesses, pipelines, utilities, energy transmission. They're boring, they're predictable, they generate steady cash flows. Right now, America is in the middle of a massive energy transition. Whether you believe in climate change or not doesn't matter. The economy is shifting toward more electricity consumption, AI data centers for AI, electric vehicles, manufacturing coming back to America. It all needs massive amounts of electricity. The electrical grid is 50 plus years old in many places. It can't handle the load. We're going to need trillions of dollars invested in grid infrastructure over the next 20 years. Companies that own electrical transmission, natural gas pipelines, and renewable energy infrastructure are going to have steady, regulated returns for decades. These businesses might not be exciting, but they're the kind of investments I can understand and value. I'm not buying yet because prices haven't reached the point where I'm compelled to act. But if we get a market correction that brings these companies down 20% to 30%, I'll be very interested. 2, consumer staples, but only the right ones. I've owned consumer staples companies my entire career. Coca-Cola, Kraft Heinz, See's Candies. These are businesses that sell products people need regardless of the economy. What I'm watching now is how companies handle the new retail environment. Amazon has changed everything. Walmart has adapted brilliantly. Target is struggling. Dollar stores are under pressure. The companies that win in this environment will be those with pricing power, strong brands, efficient distribution, and the ability to sell both online and in stores. I'm particularly interested in companies that are currently out of favor because of short-term problems but have strong competitive positions. These situations often create the best long-term opportunities. Again, I'm patient. I'll wait for the right price. 3, insurance, my old love. I started Berkshire Hathaway's success with insurance, and insurance companies remain some of the best businesses in the world when managed properly. Here's why I love insurance. Customers pay you up front, you invest that money, and you pay claims later. If you're disciplined about underwriting, meaning you don't insure risks you don't understand, you can make money on both the underwriting and the investment income. With interest rates now significantly higher than they were 5 years ago, insurance companies can earn much better returns on their float. A well-run property and casualty insurer can generate 10% to 12% returns on equity in this environment. I'm always looking for insurance companies with strong underwriting discipline, good management, and reasonable valuations. These opportunities don't come along often, but when they do, they can be wonderful long-term investments. My advice for what it's worth. All right, we're near the end here, so let me share some thoughts about what all this means for you. Remember, I'm not your financial advisor. You need to make your own decisions based on your own situation. 1. Don't panic, but don't be complacent. Just because I'm cautious doesn't mean you should sell everything and hide under your bed. That's not what I'm doing, and it's not what you should do either. What you should do is take an honest look at your portfolio. Ask yourself, am I taking more risk than I realize? What happens to my portfolio if the market drops 30%? Can I sleep at night? If you're young and you're investing for 30 years from now, market volatility is your friend. It gives you opportunities to buy quality companies at discounts. Stay disciplined and keep investing. If you're older and you're depending on this money for retirement soon, you need to be more careful. Make sure you have enough in stable, safe investments that a market crash won't devastate your plans. 2. Quality matters more than ever. In good times, everything goes up. Bad companies, mediocre companies, great companies, the rising tide lifts all boats. But when times get tough, and eventually they always do, quality separates from garbage very quickly. Companies with strong balance sheets, real earnings, good management, and competitive advantages survive and thrive. Companies built on hope and hype disappear. Focus on owning high-quality businesses that you understand. I'd rather own a wonderful business at a fair price than a fair business at a wonderful price. 3, cash is not trash. For the last 15 years, keeping cash has been penalized. With interest rates at zero, cash earned nothing while stocks and real estate soared. That's changed. You can now earn 4% to 5% on treasury bills and money market funds with essentially zero risk. That's not a bad return for money you might need in the next year or two. Don't be afraid to hold some cash. It gives you flexibility, it reduces stress, and it positions you to act when opportunities appear. 4, think long term. I've been investing since I was 11 years old. I'm now 95. Do you know what the most important factor in my success has been? Time. Compound interest is the most powerful force in investing, but it requires time to work. And it requires that you don't panic and sell at the worst possible moment. If you buy quality companies at reasonable prices and hold them for decades, you will do extraordinarily well. It's not exciting. It won't make you rich overnight, but it works. 5, stay rational. The hardest part of investing isn't the analysis or the math, it's the emotional control. When markets are soaring and everyone's getting rich, it's hard not to jump in with both feet. When markets are crashing and people are panicking, it's hard not to sell everything. The investors who win are the ones who can stay rational when everyone else is losing their minds. Be fearful when others are greedy. Be greedy when others are fearful. Final thoughts. Look, I don't know what's going to happen tomorrow, next month, or next year. Nobody does. Anyone who tells you they know is lying to you or lying to themselves. What I do know is this. I've been building the largest cash position in Berkshire's history because I can't find enough opportunities at current prices that meet my standards. I've been selling stocks, good stocks, because valuations have gotten ahead of fundamentals. Does that mean you should do exactly what I'm doing? No. Your situation is different. Your timeline is different. Your goals are different. But I hope that by sharing my thinking, I've given you something valuable to consider. Think about the risks you're taking. Think about the quality of what you own. Think about whether prices make sense given the uncertainties we face. And most importantly, think for yourself. Don't blindly follow me or anyone else. Do your own analysis, make your own decisions, and take responsibility for your own financial future. I'm Warren Buffett. Stay rational out there.